With the end of financial year fast approaching, there are a number of strategies that are well worth considering. The reason why these strategies are worth considering is because we work in Australia on a use it or lose it system. This means that if you fail to implement the strategy in this year's tax return, then the benefit will pass. All of us have only a limited number of tax years remaining at high marginal tax rate years. So it makes sense for us to put these strategies in place if possible. Firstly, there are going to be basically 5 strategies which I'm going to talk to in priority. The first strategy is maximising your concessional superannuation contributions. When we refer to concessional contributions, we're referring to those contributions made by your employer, salary sacrifice contributions made by yourself in pre-tax dollars, or contributions that you do personally but seek to claim a tax deduction for in this financial year. This year the concessional cap is $27,500 per person. That's up from $25,000 last year. So if your employer has, for example, contributed $10,000 to meet their 10% superannuation guarantee contribution, and you've contributed a further $10,000 via salary sacrifice, then the sum of these contributions is $20,000. Your concessional cap is $27,500, which means the difference between $27,500 and $20,000, i.e. the remaining $7,500, is the amount that you can contribute and claim a tax deduction on. If you're making a personal contribution and you're looking to claim this as a deduction, there is a process involved, however, in doing this. So please contact us directly regarding that. The second strategy is an expansion of the first strategy, involving what's called using carry forward contributions. So, if your total superannuation balances, that is all the superannuation funds that you own, are less than $500,000 in the previous financial year, that is, as at the 30th of June 2021, you have the opportunity to make extra personal contributions and claim them as a tax deduction. Let's take the example of Jane, who hasn't put any additional monies into superannuation for the last 3 financial years. Jane's concessional cap for this year is $27,500, but for the previous 3 financial years the concessional cap was $25,000 per annum. So the total cap Jane has over the current financial year and the last 3 financial years totals to $102,500. Jane's employer has made superannuation guarantee contributions over the previous 3 financial years of $42,000. The difference between $102,500 and $42,000 is $60,500. This is the amount that is available to be contributed to superannuation and claimed as a tax deduction in this financial year. Or, alternately, Jane may well decide to claim some this year and make contributions next financial year and spread the deductions over 2 or even 3 financial years. But remember, to make a contribution and claim it, Jane's super balances combined must have been less than $500,000 as at the 30th of June of the previous year. So detail and accuracy is important. This strategy is particularly useful if you're on a high marginal tax rate this year, or if you've had an unusually large capital gain from the sale of an investment property or sale of shares, and you need to mitigate the tax. Once again, there are complexities in this strategy that don't allow me the time to explain them, but please make contact with us if you believe the strategy may apply to you. Strategy 3 is somewhat simpler. This strategy is called spousal contributions for your spouse. If you have a spouse who is earning less than $37,000 in this tax year, then you may be able to make a $3,000 superannuation contribution and receive an 18% tax offset or $540 in your tax return. Strategy 4 is called the Superannuation CoContribution strategy and is designed for lower income earners to save for their retirement. If you earn less than $41,100 $112 in this financial year and you make a contribution of $1,000 into super and you do not claim a tax deduction, then the government will add the maximum co-contribution of $500 to your superannuation account. Strategy 5 involves the prepayment of interest on investment loans in advance. You may have an investment loan on a property or on shares. They're generally the two assets. This has the effect of bringing forward investment tax deductions into this financial year, and you're allowed to prepay rates up to 12 months in advance. The thing to think about is that it may make sense to do that now, given with the rising interest rates may now be cheaper now rather than in 12 months' time. The downside of this strategy is that you have to have a wad of cash available to make the payment. In conclusion, the 5 strategies outlined all have twists and turns, so be sure to check in with us first. In most cases, these strategies and more will already have been discussed and enacted with you during the course of this financial year. But if you have questions, or if the strategy hasn't been put in place or thought through, then please feel free to contact us.